Building a startup can be exhilarating, but it's also filled with financial challenges. Securing early investments, managing cash flow, budgeting, and preparing for growth are just a few of the essential financial pillars every startup must master. A strong financial foundation not only helps you survive the tough early stages, but also positions you for sustainable long-term success. To get it right from the start, it's crucial to develop a financial strategy that's flexible enough to evolve as your business grows, while ensuring that you stay on top of your finances every step of the way. Start with a solid business plan. The first step to creating a robust financial foundation is to develop a comprehensive business plan. This document will act as your blueprint, guiding your startup's direction and growth while outlining your financial goals. A strong business plan includes your mission, market research, product or service details, and crucially, your financial projections. These projections should cover revenue forecasts, anticipated expenses, and a break-even analysis to show when your startup will become profitable. Your business plan will also play a crucial role in attracting investors, as they'll want to see that you've thought through every aspect of your business's financials. A well-prepared plan demonstrates that you have a clear roadmap for generating revenue and managing costs. Remember, even though projections are estimates, having realistic numbers based on market research and industry benchmarks will give your startup credibility. Secure sufficient funding. One of the most critical aspects of building a financial foundation for your startup is securing the right amount of funding. Many startups fail because they either run out of money or don't raise enough capital to cover initial operating costs and scale effectively. There are multiple funding options to consider, each with its pros and cons. Bootstrapping or self-funding is a popular route for many entrepreneurs, allowing you to maintain full control of your business. However, bootstrapping often requires personal financial sacrifices and may limit your growth potential. Alternatively, you can seek external funding through investors, venture capital, angel investors, or even crowdfunding. Whichever route you choose, ensure that you have enough capital to cover the first 12 to 18 months of operations. This includes not just the startup costs, but also working capital to keep your business running as you find your footing in the market. Planning for unexpected expenses, like equipment breakdowns or market downturns, is also crucial. Focus on cash flow management. Cash flow is the lifeblood of any startup. Even if you have plenty of sales, poor cash flow management can cripple your business. Startups often face cash flow challenges because revenue can be inconsistent, especially in the early stages when you're still building your customer base. It's essential to keep a close eye on both incoming and outgoing cash. Make sure that you're collecting payments from clients promptly, and try to negotiate favorable payment terms with vendors. Setting clear payment terms, such as offering discounts for early payments or implementing late fees, can encourage customers to pay on time and improve your cash flow. Control your burn rate. Your burn rate, the speed at which your startup spends money, is one of the most important metrics to monitor closely. The faster your burn rate, the more quickly you'll deplete your capital, potentially forcing you to seek additional funding or cut back on operations. For startups, managing burn rate is about balancing growth with sustainability. In the early stages, it's tempting to invest heavily in marketing, product development, or team expansion. However, it's essential to stay lean, especially before your business has started generating consistent revenue. Prioritize spending on activities that will directly contribute to revenue generation or the core operations of your business. Implement a strong accounting system. Proper accounting is essential for tracking your financial performance, staying compliant with tax laws, and making informed decisions. Many startups overlook accounting in the early stages, only to find themselves scrambling to organize their books later on. Implementing an accounting system from day one will ensure that your financial records are accurate, up-to-date, and easily accessible when needed. Using accounting software like QuickBooks, Xero, or FreshBooks can help automate many aspects of financial management, such as invoicing, expense tracking, and financial reporting. These platforms also allow you to generate detailed financial reports, which provide insight into your business's profitability, cash flow, and financial health. Budget for growth. Growth is the goal of most startups, but it needs to be managed carefully to avoid overstretching your resources. As you plan for growth, it's important to create a budget that accounts for both the cost of scaling and the revenue you expect to generate. Your budget should cover key growth areas such as marketing, product development, hiring, and infrastructure improvements. At the same time, you'll need to be realistic about when you can expect a return on these investments. Growth often requires upfront spending, and it can take time to see the results in the form of increased sales or market share. By forecasting your expenses and expected revenue, you can plan for growth in a way that's sustainable and doesn't jeopardize your financial stability. Revisit your budget regularly to ensure that you're staying on track, and adjust it as necessary to reflect changes in your business environment. Keep debt under control. Debt can be a useful tool for startups, providing the capital needed to invest in growth or cover short-term cash flow gaps. However, it's essential to manage debt responsibly to avoid falling into a financial spiral. Taking on too much debt or failing to manage repayments can lead to cash flow problems, damaged credit, and even bankruptcy. When considering taking on debt, be sure to weigh the benefits and risks carefully. Will the loan provide a clear return on investment, such as increasing sales or improving efficiency? Can you comfortably manage the monthly repayments without straining your cash flow? It's also important to shop around for the best terms. Compare interest rates, repayment terms, and fees to find the most favorable option for your startup. Keeping debt under control will ensure that you have the financial flexibility to weather challenges and pursue opportunities as they arise. Build a financial safety net. Unexpected challenges are a part of running a startup, whether it's a market downturn, a sudden loss of a key client, or unforeseen operational costs. Building a financial safety net, a reserve of funds set aside for emergencies, can help your business survive these challenges without needing to take drastic measures like layoffs or closing your doors. Ideally, your safety net should cover 3 to 6 months' worth of operating expenses, including rent, payroll, and essential services. This will provide you with the breathing room to navigate unexpected disruptions and keep your business on track. Building a financial safety net takes time, especially in the early stages when your cash flow may be limited. However, by making it a priority and setting aside small amounts consistently, you'll gradually build up your reserve and ensure that your business is better prepared for whatever challenges come your way. Plan for taxes early. Taxes can be a major financial burden for startups, but with proper planning, you can minimize your tax liabilities and avoid unexpected bills. As soon as your business starts generating revenue, set aside a portion of your income to cover taxes. This will prevent you from being caught off guard when tax season arrives. It's also important to understand which deductions and credits you're eligible for. Many startups qualify for tax breaks related to research and development, equipment purchases, or hiring employees. Working with a tax professional can help you identify these opportunities and ensure that you're maximizing your deductions. By planning for taxes early and staying organized throughout the year, you'll avoid costly mistakes and keep more of your hard-earned revenue. Building a strong financial foundation for your startup is critical to ensuring its long-term success. From creating a solid business plan to managing cash flow, controlling your burn rate, and planning for growth, every decision you make will impact your startup's financial health. By taking proactive steps to secure funding, implement an accounting system, and plan for taxes, you'll position your business to thrive in a competitive market.